2 cities, 1 crown. Which tax haven actually wins? 2 cities, 2 tax systems. One question that millions of dollars ride on every single year. Singapore and Hong Kong, Asia's 2 financial superpowers, have spent decades competing for the same prize, the title of the continent's ultimate tax haven. Singapore promises low rates, 0 capital gains, and rock-solid stability. Hong Kong fires back with even lower taxes, 0 GST, and a territorial system that makes offshore income completely invisible to the taxman. Every year, thousands of entrepreneurs, investors, and high-net-worth families are forced to choose between them, and most of them get it wrong. This is the definitive, round-by-round breakdown of Singapore versus Hong Kong, and the answer might surprise you. Let's set the stage. Singapore, a city-state of 6 million people that transformed from a swampy British outpost into the world's 3rd richest country by GDP per capita in a single generation. Over 1,500 family offices call it home. 1 in 6 households is worth at least $1 million. Its pitch is simple: low taxes, 0 capital gains, and absolute stability. Hong Kong, 7.5 million people packed into 1,100 square kilometers on the edge of mainland China. For decades, ranked the world's freest economy. Its tax code has only 3 direct taxes: no VAT, no sales tax, no capital gains, a maximum income tax rate of just 15%. On paper, Hong Kong looks like the clear winner. But on paper isn't where people live. Let's go round by round. Round 1, income tax. In Singapore, residents pay progressive rates from 0 to 24%. The first 20,000 Singapore dollars are tax-free, but the top rate hits 24%, raised from 22% in 2024 for anyone earning above $1 million. Someone earning 200,000 Singapore dollars pays roughly $7,950, an effective rate of about 4%. Generous. But Hong Kong? Hong Kong's maximum is 15% under the standard rate, or 17% under progressive rates, whichever is lower. The first 132,000 Hong Kong dollars is exempt. Someone earning the equivalent of 200,000 Singapore dollars in Hong Kong pays about half the tax. And here's the killer detail: Singapore raised its top rate. Hong Kong hasn't touched its 15% standard rate in decades. Round 1 goes to Hong Kong, and it's not close. Round 2, corporate tax. Singapore's headline rate is 17%, but startups get an effective rate of just 4.25% on the first $100,000 of profit for the first 3 years. Government rebates bring many small businesses under 10%. Hong Kong counters with a 2-tier system: 8.25% on the first 2 million Hong Kong dollars of profit, 16.5% on the rest. But Hong Kong has a weapon Singapore can't match: territorial taxation. If your profits are earned outside Hong Kong, the tax rate isn't 16.5%. It's 0. Singapore technically taxes worldwide income, with exemptions for foreign income already taxed abroad. Hong Kong simply doesn't care where the money comes from, as long as it wasn't earned in Hong Kong. Round 2 is a draw. Singapore wins for startups. Hong Kong wins for anyone with international revenue. Round 3, consumption tax. And this is the round that shocks most people. Singapore charges a 9% goods and services tax on almost everything: food, electronics, services, imports. It was raised from 7% to 8% in 2023, then again to 9% in 2024. For a business spending $500,000 a year on goods and services, that's $45,000 in GST alone. For consumers, it's a silent tax on every purchase, every single day. Hong Kong, 0%. No GST, no VAT, no sales tax of any kind. Hong Kong is one of the only major financial centers on Earth with absolutely no consumption tax. They considered introducing one back in 2006. The public said no, and that was the end of it. Round 3 goes to Hong Kong. Knockout. Round 4, property. This is where Singapore shows its teeth. If you're a foreigner buying residential property in Singapore, You'll pay a 60% additional buyer's stamp duty on top of normal stamp duty up to 6%. A 2 million Singapore dollar condo costs 1.27 million in stamp duties alone. That's not a tax, it's a wall. Hong Kong used to charge 15% buyer's stamp duty for non-residents. But in February 2024, they abolished it entirely. Scrapped the special stamp duty on resales too. Today, Hong Kong's maximum property stamp duty is just 4.25%, regardless of nationality. Neither city taxes capital gains. Neither has inheritance tax. Neither has wealth tax. But when it comes to property, Hong Kong opened the door while Singapore slammed it shut. Round 4, Hong Kong. Let's check the scorecard. After 4 rounds, Hong Kong leads 2-0 with 2 draws. Lower income tax. No GST. Open property market. If this fight ended here, Hong Kong would be the undisputed champion of Asian tax havens. But this fight doesn't end here. Because so far, we've only looked at tax rates on paper. And the most important costs? They never show up on any tax return. Round 5, the hidden price. Hong Kong is the most expensive housing market on earth. A 1-bedroom apartment in Central rents for 15,000 to 28,000 Hong Kong dollars a month, up to $3,600 US. A family apartment in mid-levels, 50,000 to 100,000 a month. International schools charge 200,000 to 300,000 Hong Kong dollars per child per year. Private healthcare costs 4 times what Singapore charges. You save on GST and income tax, then hand it all back in rent. Singapore is expensive too, but the government manages costs actively. Public housing through the HDB system keeps 80% of residents housed affordably. Healthcare is subsidized. A 1-bedroom in the city center runs 2,500 to 5,000 Singapore dollars, roughly half of Hong Kong. The tax you save in Hong Kong, you often pay right back in living costs. Round 5, Singapore. Round 6, tax treaties and global structure. Singapore has signed over 100 double taxation agreements, nearly double Hong Kong's 55. That means Singapore-based companies can move money across borders with lower withholding taxes in twice as many countries. Singapore also offers pioneer certificate incentives, full tax exemption on qualifying income for up to 15 years, development and expansion incentives that drop the corporate rate to just 5% for a decade, and a refundable investment credit introduced in 2025 that covers up to 50% of qualifying business investments. Hong Kong's incentive toolkit is thinner, no pioneer schemes, fewer sector-specific tax breaks. And while territorial taxation is powerful, it's a one-trick pony. Once your business earns income in Hong Kong, the standard rates apply with no special deals. For building a global business headquartered in Asia, Singapore's infrastructure is simply deeper. Round 6, Singapore. Round 7. And this is the round that changes everything. In 2020, Beijing imposed the national security law on Hong Kong. In 2024, Article 23 added more. Over 250 arrests. U.S. companies in Hong Kong dropped to their lowest level since 2004. Regional headquarters fell 13% between 2019 and 2023. When companies were asked where they'd relocate, 9 out of 10 named Singapore. One country, 2 systems expires in 2047. Freedom House rates Hong Kong partly free, with a declining trajectory. Singapore? Stable government. Transparent rule of law. AAA credit rating from every major agency. No geopolitical entanglements. Hong Kong's tax code hasn't changed, but the system around it has. And for long-term wealth planning, predictability matters more than any rate on paper. Round 7, Singapore. Decisively. Final scorecard. Hong Kong wins income tax, GST, and property, 3 rounds. Singapore wins hidden costs, tax treaties, and political stability, 3 rounds. Corporate tax is a draw, dead heat. But here's what the scorecard doesn't tell you. If you're an employee earning under $500,000 a year with no property ambitions, Hong Kong puts more cash in your pocket. Period. If you're a startup founder building a global business, Singapore's incentives, treaty network, and stability make it the obvious base. If you're a high-net-worth family parking generational wealth, Singapore wins by a mile. The money you save in Hong Kong means nothing if the rules change overnight. And if you're a crypto investor just passing through, both cities are tax-free on capital gains. Take your pick. The real tax haven of Asia isn't a place. It's a strategy, and the right strategy depends entirely on who you are. If this breakdown changed how you think about taxes in Asia, hit subscribe. We decode the world's most complex tax systems into strategies you can actually use every single week. Are you Team Singapore or Team Hong Kong? Drop your pick in the comments and ring the bell so you never miss the next move on the tax map.